I think it's not unlikely that we'll sell some Bitcoin between now and the end of the year. I don't know how much. We still consider these things. But it's also likely that we'll sell a mixture of equity, a mixture of credit. We'll manage our USD, our cash positions, and we do it in a very thoughtful, programmatic fashion. We enjoy keeping everybody guessing. It definitely makes X a lot more interesting. Um, our view is business as usual here. We're kind of matter of fact about this. The goal of the company is to drive Bitcoin per share and to increase its Bitcoin and increase the enterprise value continuously forever. Bitcoin is its own asset, and it's driven by geopolitical capital flows.
Still watching your portfolio swing 20% and not knowing whether to buy, hold, or get out? You're not alone. Most people in crypto are just reacting. Very few are actually reading the market. This channel is for the ones who want to read it. Bitcoin, macro, on-chain data, institutional moves. We cover what actually drives price. Sharp analysis, no noise. If you're serious about this market, subscribe and turn on notifications. You don't want to miss what's coming. Michael Saylor just said something that sent shockwaves through the Bitcoin community. The man who built his entire identity around never selling Bitcoin just told the world it's not unlikely that strategy sells some before year end. Markets had already priced it in. Prediction markets had the odds at 84%, but hearing it directly from Saylor in that flat, matter-of-fact tone he uses when he's already made up his mind, that's different. And then, almost in the same breath, he says he expects Bitcoin price to go up forever. That the company's job is to increase Bitcoin per share continuously, forever. That they're running algorithms, making trading decisions every single second. So which is it? Is this a company that's quietly capitulating? Or is this a company so deep in the math that selling Bitcoin is just another variable in an equation most people don't understand yet? That's the question, and Saylor has a very specific answer. But here's what most people are missing. The Bitcoin sell conversation is almost a distraction, because what Saylor laid out in this Q&A goes way beyond one trade. He's describing a new financial architecture, a Bitcoin reserve bank, a $300 trillion credit market in the process of being digitized. And he's naming a specific roadmap to get MNAV from where it is right now to 3, 4, maybe 6 times. He also named every single headwind Bitcoin is facing right now: rising rates, the AI capital rotation, miners liquidating to fund compute infrastructure, and he was direct about all of it. This is one of the most transparent conversations Saylor has had with retail investors in a long time. Stay with it.
I think we enjoy keeping everybody guessing. It definitely makes X a lot more interesting. Um, our view is business as usual here. We're kind of matter of fact about this. The goal of the company is to drive Bitcoin per share and to increase its Bitcoin and increase the enterprise value continuously forever. Um, We'll make decisions about how we fund our liabilities week by week, day by day. Sometimes we make them minute by minute, to tell you the truth. We set algorithms where we're looking at what is most long-term advantageous to the company. Are we managing our credit risk? Are we creating Bitcoin per share? And are we best off to pay a liability with cash, or to pay a liability by issuing equity, or to pay a liability by issuing credit, or to pay a liability by selling Bitcoin? We've done a lot of multivariate models, and in all the models, what we find over the long term is that by far the best thing for the company is to engage in a mixture of those four instruments. Any model that we put together that's limited only to equity or only to credit or only to Bitcoin always underperforms. So ultimately, the way to think of it is 7 years out, we would like to have maximized our Bitcoin per share. and what is it that we should be doing now that's going to maximize and optimize the company's performance so that we've maxed out Bitcoin per share 7 years from now. And I think it's not unlikely that we'll sell some Bitcoin between now and the end of the year. I don't know how much. We still consider these things. But it's also likely that we'll sell a mixture of equity, a mixture of credit. We'll manage our USD, our cash positions, and we do it in a very thoughtful, programmatic fashion where we're running our multivariate models, and we're literally running them. We're making trading decisions. To say every minute might be an understatement. We oftentimes make trading decisions every second, and we'll continue to do that. We don't have a legal obligation per the security itself, but it is the company's number one business objective. So the way to understand it is we have about an $80 billion enterprise. And if you were to ask, what is the number one thing that we want to ensure month by month, quarter by quarter? We want to ensure the stability of STRC around $100. If STRC doesn't hit the $100 peg each month, then the company is going to take action in order to strengthen it. And we've shown ourselves wanting to do it. We raised the dividend, was it 6 times in a row, or 5? How many times, Fong?
I think it was
many times. We raised the dividend multiple times. We raised billions of dollars of capital and bought Bitcoin with it. We raised billions of dollars of capital and we put in a US dollar reserve. We have just bought back $1.5 billion of debt, which is senior to STRC. So we will restructure the capital structure. We will raise capital. We will adjust the dividend. We went and put a presentation or a proposal in front of our shareholders to double the frequency of the dividend. So all of those things I just named are all in pursuit of stability about around the $100 target. So you can think of it as a business objective, and you could almost view it as that's the reason that the company is here. Like that is the primary KPI for strategy, is to stabilize and make the digital credit successful. And I would contrast that to, we're not terribly concerned about the price of a convertible bond trading in the OTC market. And if you were to ask, how do we feel about the price of STRD, STRF, STRK, STRE? Well, we'd like them all to be higher, but we don't get up every week and every morning and obsess over what we need to do in order to deal with those securities' performance in the market. Or in the near term, MSTR is going to move around. The primary flagship security of the company is STRC, and the primary objective is to strip the volatility and stabilize the instrument at par. When you design a structure to be anti-fragile, whether it's a skyscraper in Manhattan or whether it's an aircraft wing, it's important that it flex. If you try to take the flex or the motion out of the building or out of the wing, it'll be rigid and then it will snap. And so we're not really defending the peg of $100 in the same way that, say, a stable coin issuer would. If you were a bank or a money market or a stable coin issuer, you have deposits and they're daily deposits. They're almost debt, like 1-day loans, and you literally have to defend them down to the penny or to a sub-fraction of a penny. That's not the design of STRC. STRC is designed so that it will trade at par for some portion of the month, and then it will trade down 50 or 100 basis points. And that's all part of the engineering. If you look at those DeFi protocols, let's say there's one with $300 million in it. We have $10 billion of AUM in STRC. how does the instrument perform when someone wants to sell 300 million or 500 million or a billion of STRC in a single day? Well, we already know the answer. It'll trade down 50 to 100 basis points. Maybe in the extreme, it'll trade down 150 basis points. And someone in our ecosystem, not us, a hedge fund, right? A large hedge fund that has 50 billion or 100 billion dollars will step in and they will buy it. And that's why it is so anti-fragile. So I think that, and I think you can see it, it seems like we have about $1 billion to $2 billion of support when the instrument trades down 75 to 100 basis points that'll just walk into the market very quickly. But if someone were to dump $2 billion of STRC on the market in an hour, right? Like just take an extreme amount. You'll see the support for STRC will exponentially increase as the price falls. So below 99, there's a lot more support. Hedge funds will walk in and buy it because they get a quick 150 basis point gain in a couple of days. Below 98, you will see even more support. Below 97, even more support. This is, if you study the way ships are designed, where they have a center of gravity, and the whole point of nautical stability is there's a force, as you push the ship down, there's more force pushing it up. And as the ship sways left or right, there's more force bringing it back. It's basically stability theory. And so I think we're not concerned about the fact that someone may decide to sell some large amount of STRC. The instrument's literally designed so that it's insanely profitable for the hedge funds and the other credit investors to buy it. That they would, if I would have talked to them, there's a lot, they will buy it at 97 or 98 if they had the opportunity. They'll sell it at par, right? That they exist to actually support it back up to par. And when it's trading at $99.98, they don't have much incentive to step into the market. The incentive for all of the third parties that support our ecosystem increases exponentially as it trades further away from par. So you could think about the entire thing as a very elegantly designed servo mechanism where it's much better than us stepping in to defend the peg. We have, I think, an entire cohort of investors, and they have hundreds of billions of dollars of capital, and they will step in to defend STRC because they trust us, and they know over the long term it's a very good investment. So we can't know that a corporation won't get up and decide to dump $200 million of this tomorrow. And we already know that once a month someone buys $1 billion and they sell it the next day. So we already know that happens. In fact, it's part of the design of the instrument for that to happen. And that's why we're comfortable that the entire digital credit layer is anti-fragile, because it's designed to flex and not to fail. I think the first thing that we do is make sure that we illustrate to the equity holders, to the common shareholders, that we can increase Bitcoin per share. So Bitcoin BTC yield last year was 20% plus. BTC yield this year so far is 12% plus. So I think putting a healthy BTC yield, or an increase in Bitcoin per share, this year, last year, and show them how we're going to do it going forward. I think that's the first thing. You're demonstrating that the business model can generate more Bitcoin per share. Once you've done that, then it's an education process to go and educate the equity capital markets. If the company hypothetically can generate 10% BTC yield a year, you can double Bitcoin per share over 7 years, and that's worth a premium to NAV. But if the company can generate 20% BTC yield, you can double Bitcoin per share in 3 years. That's a much faster growth rate. That's worth a higher premium to NAV. When the market when the market sees BTC yield, right, that's sort of the dividend yield for someone on the Bitcoin standard. So if you're Bitcoin maxi on the Bitcoin standard, you're saying, okay, well, 20% would be a 20% dividend yield. And then the question becomes, okay, have you embraced the Bitcoin standard? If not, you don't recognize that as being valuable at all, right? But if yes, then yeah, that's 20%. Now, the second question is, how durable is the business model? So if I thought that would last for 10 years, I might put a P to E of 10 on it, and I might say, I'm going to multiply 10 times 20 and give you a 200% premium to your Bitcoin holdings. That works out to an MNAV of 3. If, on the other hand, I thought that was going on for 20 years, right? If I was really very confident, the P to E might stretch out further. You could say that when you see a business model that the equity capital markets are hyper enthusiastic about, I'll give you an example. Apple, when people thought the iPhone was going to get commoditized, had got a P to E of 8. And then when people thought everybody's going to use the iPhone and it's the best thing ever, the P to E went to 30. And so when the market embraces the business model, the P to E expands. And right now, we're in embryonic state. I mean, the business model is dynamically evolving. It was convertible bonds about a year ago, a year and a half ago, and now it's digital credit. And digital credit is 10 months old. And for the last 3 months, the digital credit business last month was a $24 billion annualized run rate. And 12 months ago, it was a $0 annualized run rate. So we have to go out and we have to communicate the power of stretch digital credit to create BTC yield. And then the question becomes, explain the stretch thing again. How much of this can you sell? How does it work with the Bitcoin? How does it work with the capital? And now an equity investor, they have to consider the business model to consider how durable it is, and based upon that, they'll put a multiple on the key metrics. So our plan to drive MNAV to 3, 4, 5, or 6 is kind of simple. First, make sure that the business can generate Bitcoin per share. The more, the better, right? The faster we generate Bitcoin per share, the higher the BTC yield, the higher the premium that is warranted. But second, we need to build the machine so that we can keep doing this consistently over the next decade. So it can't be a one and done. And so first you build a machine, then you make the machine capable of running the marathon and running hard for the next decade. And then third, you have to go communicate that to the marketplace and explain it to them. They're rational investors. When they understand how you create shareholder value, and then when they understand the risks associated and the unique capabilities the company has, then they will decide, yeah, I'm going to put a PD of 5 on that. At a 5, then they give you a 100% premium. Maybe I'll give you a 10. Maybe that's a 200% premium. Maybe I'll give you a 20, right? And that's a 400% premium. And then of course we got to perform. And so I think we're simultaneously doing things, make the credit better, sell the credit, manage the balance sheet, strip the credit risk, and then we're communicating things. And the market is digesting and absorbing a revolutionary new business model. Digital capital is a new asset class. Digital credit is a new asset class. Digital equity is a new asset class supported by the digital treasury model. And a treasury company is like a reserve asset bank. Like the Bank of England was founded to buy a bunch of gold and issue credit against the gold 300, 400 years ago, whatever, 300 years ago. And so here we are, we're creating a Bitcoin reserve bank of sorts, and we're buying Bitcoin, issuing credit against it. You can't blame an equity investor for looking at it and saying, gosh, this looks new and different and strange, and I've never seen this before. And there's a concept a concept that Nicholas Taleb popularized. He called it the Lindy effect. And he said that if a restaurant had been around in New York City for a decade, it's likely to be around for a decade more. If it's been around for 50 years, it'll be around for 50 years more. So when you've seen a business do its thing for a year, then a skeptical investor's like, well, maybe if it's been around a year, we're just going to assume it'll go on for one more year and we'll be kind of skeptical. And once you understand the Lindy effect, that products get exponentially more valuable as they get Lindier, as they get longer lived, then what you just see is a bunch of rational actors in the capital market absorbing information, taking risk, and allocating assets based upon all of the information and the durability of the business model over time.
So here's where we are. Strategy is not the buy and never sell company the memes made it out to be. It never was. Saylor just made that explicit. The company runs models every second, weighing equity, credit, cash, and Bitcoin against each other. And the output of those models may include selling Bitcoin before the end of this year. That's not a betrayal of the thesis. That's the thesis operating as designed. The goal has always been Bitcoin per share. Not Bitcoin held, not total Bitcoin count, Bitcoin per share. And is selling a small amount of high cost basis Bitcoin at a tax loss while issuing credit at scale produces more Bitcoin per share over a 7-year horizon, then that's the trade. The $100 peg conversation is the part of this that most people are underestimating. Saylor didn't describe a company defending a price target. He described a self-reinforcing system where hedge funds with hundreds of billions in capital have a direct financial incentive to step in and buy every time STRC trades below par. The lower it goes, the more profitable the trade and the harder it snaps back. That's not marketing, that's mechanism design. And then there's the bigger picture, a $300 trillion credit market being digitized. $100 billion companies, Saylor believes, will be built on top of Stretch. A Bitcoin reserve bank model that's 10 months old, running at a $24 billion annualized pace. If you're holding MSTR or STRC, the one number Saylor said to watch is BTC yield. Not Bitcoin price, not MNAV, Bitcoin per share, and the rate at which it's compounding. 5 years ago, Strategy had 50,000 Satoshis per share. Now, it's over 200,000. That's the scoreboard. If this video gave you a clearer picture of what Strategy is actually building, hit subscribe. We cover Bitcoin, macro, and the capital markets that most channels won't touch. New video dropping soon.